a very good day to everyone listening. Obviously, it's me, Paul, from the Sirius report. And I'm very pleased to say I'm joined today with our very good friend, Paul, who's obviously in Latvia. And Paul obviously can, if he wants to, can explain a bit about who he is and what he does. But what we principally want to do today is to discuss things that are of mutual interest and relate to economics, financial markets, and things that we feel are important for people to understand, because we're certainly seeing clear evidence of a breakdown in decades-long market correlation. And at this point in time, I think it's worthy of us getting together and having another chat about it. So good afternoon, Paul, and thank you for joining me.
Hello. It's my pleasure, as always. I think it's our third time doing this.
Yes, I think
So,
that's right.
and every time I enjoyed this immensely. So, hopefully, it will be of interest to everyone listening. Um, about myself, well, I'll keep it very brief. I've been in finance for a long, long time, around 25 years by now. And currently, I'm a partner in an asset management company. But basically, I've been trading for 25 years, trading everything pretty much. So yeah, that's the brief part of it.
Yes, I mean, well, just to give people a bit of an understanding of, I'm sure there are
Yeah.
people who already understand your background, but it's good just to give people a little bit of insight to what you do, professionally speaking. So, where do you want to start today? And then obviously, I'm going to try and make sure this isn't an interview and I interact, but I'm very intrigued for everyone to hear what you're saying. I'll obviously chip in as and when. I think it's a good point to do so.
Yeah, well, it's really up to you. We can go in any direction you feel is appropriate, but I think we are currently in a very unique uh, time period of major changes, and I think it's important for people to realize how this change relates to actual, correlations and stuff like that, because a lot of people are missing it from what I see. And it's a bit of a slow-mo wreck kind of scenario. You see things change, but you can't make sense of them and stuff like that. And I do believe that the system is changing dramatically in terms of how the world trades, what the world uses as a collateral asset, and how all of this interrelates. And I believe that we are, you know, past the point of return. The processes that we see today, they are here to stay, probably for a number of decades ahead, right? And I guess we could start with the breakdowns of correlations that I see. What do you think? Shall we
Yes,
shall
I
we
think that's
start with that?
a great place to start, because you're absolutely right. It's my experience. Obviously, I have a very different perspective on what I do compared to you. I'm not sort of the coalface end of operations on a day-to-day basis as you are, but yes, there are certainly correlations, and I think a lot of people are either don't understand, which is perfectly normal, or there's some element of people burying their head in the sand, particularly people who are used to a dollar-centric world and believe the dollar-centric world may not be quite as efficient as it once was, or maybe adoption rates aren't quite what they were, but it's going to be around for another 20, 30, 50 years. Well, it's absolutely clear that's not the case, but we have to make the point when I say that. I'm not saying the dollar disappears full stop, of course not, but the dollar as what you might define as a world reserve currency, as it has been for decades, will no longer be the case. And there is this big change. And what we want to discuss, and obviously Paul will introduce this, is this breakdown of correlations, which is very clear, it's self-evident, and it's very indicative of these big changes that we're seeing now, and something I've spoke about for 10 years that this was coming. And And now I think I've had people in the last 6 months actually getting in touch, going, "Well, I finally can see it myself, and I understand." And I don't understand how you knew this a decade ago, but they can clearly see this. So I think that's a great starting point for us to have in this discussion.
Yeah, so before we go through the list of correlations that are breaking down, I would like to add that I believe it's wrong to think of the dollar just in terms of fiat cross rates. And that's the typical approach. You know, when you talk to someone, and I encounter this every day, people talking about the dollar in terms of euro dollar or dollar yen or something like this. But when you talk about the reserve status, I think it's important to differentiate the currency you use to transact and the collateral, you know. And essentially, the currency you transact in can be anything. What is important for the system as a whole is the collateral. And basically, from 71 up to, I would say, 2014, that's debatable, but let's say it's that period. It's been a US dollar centric system, meaning that US treasuries were used as collateral, you know, as the actual reserve. So you could transact in euro, but if you ended up buying US treasuries, that's the important part, not the dollar itself. And I think a lot of people don't understand it still, despite all the stuff that's going on in US treasuries. And I just wanted to point that out and, you know, advise anyone to think in a broader way about the dollar, you know. So obviously, in that respect, gold is important because that's the alternative. That's the new reserve asset that is actually replacing U.S. Treasuries as we speak, right? So, and I think a lot of the breakdowns of correlations are to do with that. So I can just start, I guess.
Yeah, sure.
I think it's important. Like if you look at the cross rates for the past couple of months, you'll see that the dollar is kind of flat. You know, it drops against some currencies, goes up against others. But it's more or less in the same spot if you look at it from the DXY perspective, which is the dollar index. It doesn't have all the currencies in it, but it has the biggest ones, right? So euro, yen, pound. Um, and it's flat, but gold is breaking out to the upside. A lot of other commodities are breaking out. I would say the dollar is weakish against oil. And it is a bit of a break in you know historic relations because typically what you would see is falling dollar and commodities rising, right? And
Mhm.
it seems to be decoupling from that, right? So these days you can see commodities go up in dollar terms without the cross rates moves. And I think that's important because that's exactly what you would expect in the case of the move from one collateral to another, right, in the substitution process. So that's one, and I find it intriguing, and I'm wondering if we just at the start of this commodity rally, because if you assume that the dollar could fall, for instance, would that be, you know, would that add to the rally? And I think it will, because historically it happened. And if commodities are strong without the aid of the weaker dollar, I'm sure they will, you know, it's like pouring, you know, gasoline on the fire kind of analogy. Um, so yeah, that's something to think about. And I do think that the dollar will depreciate on cross rates too, just because the deficit needs are so big and, you know, and they keep increasing really. So that's one. Another thing I would like to point out is that this tightening cycle was a little bit weird. And I mean, the dollar tightening cycle, right? So hiking rates and making the dollar more expansive in that respect. Typically, what happens is some sort of emerging markets bond crisis, because the reason for this is a lot of emerging markets sovereign debt is denominated in dollars. And obviously, if you make it more expansive and more scarce, then it's more difficult for these countries to pay it off. And normally, what would happen, and like most emerging markets are commodity countries, right? They benefit from higher commodity prices, typically, not all of them, but normally. And this tightening cycle, it basically forces emerging market economies to increase their production of resources, and this leads to price decreases of the commodity complex. This didn't happen this time round. There was no crisis at all. I would say there were a couple of restructuring issues in places like Zambia and Ghana. But all of these are local stories and they're getting restructured. But overall, it does feel like someone is bankrolling the deficits of these problematic countries, right? Even when the dollar is pricey. Um, and I think it's pretty clear who is doing that, and it's basically China and the Arab countries these days. I think it's interesting to look at what happened to Egypt. UAE started a joint venture project with Egypt just a few months ago, I think a month ago, and they basically gave Egypt around $30 billion just to work in this coastal town. They're developing this coastal town. And he was always, I think they always kind of backed them. But these days it's out in the open, and I think this case, it's kind of a blueprint for all other EM kind of interactions with the Arab world, but also with the Chinese. And I think we'll be seeing more and more of stuff like that. So that's another thing that is very different, and not typical in a tightening cycle. I think that's important too, because it means that EM bond market is very, very different from what it was for the past 20 years, say, right? So that's another one. The big one, I think that a lot of people talk about, but also a lot of people do not realize how important it is the fact that gold is rising against dollar while US real rates are positive. As you know, and as everyone knows, gold is not a productive asset in terms of paying interest or dividends. I mean, it's a piece of metal, literally. It costs you to hold it, whatever the form. And normally, when US real rates are positive, it means more competition for gold because you get some yield on factual basis, right? While gold does not. But this time it is rallying alongside real rates being positive. So it's not supposed to be
Hello.
worth mentioning. And it's the kind of stuff that can happen only when the world is moving to gold as a reserve asset in favor of US treasuries. There's no other explanation. It basically means that the global south, the proverbial global south, is choosing gold as opposed to US Treasuries, right? It's also interesting that gold is still massively underowned generally, but especially in the West. The numbers are all over the place, but I'm hearing less than 1% of allocation in the West among asset managers and stuff like that. And it's quite amazing because gold has been outperforming S&P 500 total returns since 2000. So, more than 20 years now. So it doesn't make any kind of scientific sense to avoid gold. I'm not sure why this is the case. I guess it's been uh, I can't even find the word, the right word. Um, Hated, I guess. Gold has been so hated by media and by the professionals that that's where we are. But, you know, it's still rallying, right? So you can't deny it. Another thing that I think is interesting is that gold in recent months has rallied in a relatively low volatility environment, at least so far. And typically, you would see big spikes in gold prices when volatility rises as well. And it has been going up a little bit, but it's still very low comparatively. So if you believe that vol should be going up alongside the rally, then maybe current prices are not that high yet. And again, another break of correlations, as if something has changed, stuff like this. And the last one that I look at in this kind of fiat versus gold versus USD stuff is the fact that spreads have been stubbornly high in Shanghai than in London, in Chicago, or the prices, not the spreads. So there was a positive spread, and it's still there. And you basically get a premium in Shanghai over London and Chicago in terms of gold price. And it means that the West has lost its power of control over the gold price because of that. It essentially means that there are arbitrage opportunities all over the place. You basically sell in Shanghai, buy in London, and you can do it in perpetuity. So who leads who? That's the big question. And again, that's a bit of a change because normally we had those spreads breaking out regularly before, but they would come down fairly fast. This time, it seems that they're staying elevated, and I think it will stay this way for a while. Like basically, these are the how many was it? Six breaks that I think is important, that I think are important, and it's very difficult to ignore this for someone like me who is positioned every day for clients and for myself. And I look at these things and I just can't avoid the idea that something has materially changed and it's just, super difficult to ignore. And I don't think people should ignore this. Maybe you have some other ones you could add. Do you have any other
Well, I think what
breaks
I
of
do
course?
is, comment on what you've said. And I mean, I've made this point before that the US hiked interest rates not to curb inflation. It was to try and protect the dollar because everything in the United States, whether it's done largely it's geopolitical, it's economic, it's fun. It's all about preserving the dollar, and hiking rates was based on the anticipation, as you said, that they would have caused an emerging market bond crisis. It would have forced countless nations in emerging markets to be going to the IMF with a begging bowl for more dollars, and it's failed spectacularly. You're right in saying there are some countries who have experienced problems, of course, and Egypt and the UAE is a great example where it has become public knowledge now. It used to be done rather quietly, but also barter's a big part of this as well. But you're absolutely right. I know I had a conversation with someone last November who was saying basically what the Chinese were proposing to do is they were going to backstop problems. They've got enormous forex reserves. They have the dollars. They have the capability to backstop a problem and invest in countries. And of course, it's from the Chinese perspective, it's the so-called win-win cooperation. We invest, we get something out of the investment. It benefits these countries, and also encouraging these countries where possible. And it's not easy to necessarily do, but increasingly, and it was always a long-term strategy for getting out the dollar, was to trade in local currencies, because if it's possible, it irons out all these wrinkles of having to exchange into dollar and your currency's being smashed to pieces, and it becomes very inflationary. And they've managed to evade that problem. And this has been a huge shock to the United States, because hiking interest rates has not achieved its objective. And if you look, you're right, with you look at the price of gold, and if you have US real rates that are positive, well, narrowly that would have an impact on the price of gold. And in fact, it's quite the reverse, I think, since they started hiking rates. Obviously, the figure's fluctuating a bit, but it's gone up. Or gold, basically in gold terms, the dollar's depreciated 20%. Now,
Mm.
you would expect now, and I think there was an expectation in the US that the gold price would have now been somewhere like $1,200, $1,300 an ounce, and not 2350 or whatever it is whenever I last looked at it. Then that's been a big shock and a big sort of wake-up call for the US. That you're absolutely right in terms of the fact that the US Treasury as a favored reserve asset is giving way to gold. And this comes back to the point I made when someone asked me, when will we get true price discovery for
Mm.
gold and by extension silver? And this was 2013. And I went, when the West is effectively drained of gold.
Yeah.
And therefore, because I knew at the time, because in 2012, and I've made this point before, for 2.5 years, so 30 months, there was 1,000 metric tons of gold heading from west to east,
Mm.
30,000 tons. It was very clear what the perspective of the Chinese were, and by extension, global South nations. We've seen this in, and some European nations have continued to buy gold. There's a big shift of emphasis away from a dollar-centric world. And people said to me, this is nonsense, it's never going to happen. I said, well, when it happens, you'll start to see correlations breaking and things won't make sense. Now, of course, now we're in that cycle where it looks like it's happening, but I keep cautioning people saying, look, it's early days. I mean, we've had a couple of months, maybe 3 months of this, but let's see where we are in 3 to 6 months. I mean, there's clearly attempts to try and smash the price, and it's failing. I mean, I've seen it this week on 2 or 3 occasions, and it bounces back, and based maybe for no apparent reason, or sometimes some economic financial data comes out, which of course is meaningless and nonsensical anyway. But it's confusing that people in Washington and in Europe go, hang on a minute, why is it? No one's, because it's true, relatively speaking, and like you, Paul, I know people who deal in the gold markets, they're saying to me, it's so quiet in the West. There's even
Mm.
retail interest is fairly small, high net worth investors, non-existent, institutions, etc. Okay, we know sovereign nations are buying them, and some of them in the West, but not many. And the
Mm.
perspective is, well, why is all this gold action happening in China and India and also in other countries? Why is that driving the price? And because they can't understand it. Well, it always comes back to my point with Western markets, which are paper based. There always comes a point when it's totally unsustainable, in the sense that we know that if you've got a 1 ounce contract in the COMEX or the LBMA, it's not going to be backed by 1 ounce of physical metal. We know it's hard to suggest what, there's a lot of figures banded around about the ratio, what it is between paper and physical metal. But if more and more metal ends up going east, there comes a point when there's a breaking point where it's unsustainable, and they can't manage this position because they can't dare risk having a situation where someone who notionally has an enormous gold holding in the West, goes, I want delivery, and they can't
mm,
deliver. And then it's force majeure that they can't
mm,
allow that to
mm,
happen. So there comes a point where the imbalance is so great, and I think we're at that position. And I, on my own podcast, was talking about the sort of September, October last year, saying there seems to be indication that the paper markets, as I refer to them in the West, are breaking down. And we seem to be in that cycle, and it all is on the basis of what you've just discussed, Paul. So I think, to be honest, they're the fundamental points that it isn't a dollar centric world. It's changing. Okay, the West, as far as it's concerned, it is, but the global South going, well, we have a different perspective, and a lot of this has come out on the back of the fact that the US has weaponized the dollar for a long time, but in more discreet ways. And but then they went full throttle with the Ukraine war, and I made the point at the time, sanctioning Russia's central bank and effectively freezing, stroke potentially stealing their assets was the worst decision anyone's made, because it just made the global South go, well, we've been warned about this, we've been advised by the Chinese and the Russians this could happen, well, we could be next. So we want to get out of the dollar centric world as fast as possible, and hence the move to local currencies, and then these breakdown of correlations between US dollar, US Treasury, and gold. And I think they're extremely important points. And to be honest, I see a lot of people who are still thinking that somehow the gold markets in the West relate to what's going on in the West. So our favorite subject of, well, in terms of
mm,
TA, technical analysis, gold's overbought. I mean, that's like, what does this even mean? How can physical markets, which now seem to be dominating more than paper markets, be based on this weird scenario of, well, it's overbought? I mean, it's, if you have true physical demand and supply, the market's very different. So people are still sucked in largely into the belief that, well, yeah, there's something not going on, but it's not some groundbreaking fundamental change in the world, which of course it is, and increasingly in the next, I would say, 2, 3, 4 months. I think
mm,
if indeed we are at that point, and it really is, and it's not just, I wouldn't call it a false dawn, but it's not necessarily going to have momentum as we expect when it really is happening, in the sense that
mm.
I do agree with you, though it's an irreversible process, but it might have some glitches along the way. It might not be this kind of perfect scenario where it just seamlessly moves. There's going to be attempts to try and disrupt this, because I think at some point when gold reaches, and I've made this point because someone said to me, when do you think institutional interest and everything might change in the West? And I went, well, maybe if gold hits 25, 26, 2700, then subconsciously or consciously or just psychologically, it might start unnerving some people in the West. And of course, for gold, that's kind of the perfect storm. If suddenly it's not just massive demand in the East, but suddenly there's much more demand in the West. And I know people who'll constantly tell me when that starts to happen, then I think then it's that we might be really off to the races there. But again, for me, people say to me, what price do you think gold will be? And I'm not interested. My point's always been with gold, it's effectively shielding you against all eventualities, but more importantly, when we get out the other side of this disastrous failed fiat monetary experiment, it's what's its purchasing power. That for me is what, and therefore I don't focus on the price, and I never have, and I never will. But there will come a point where I will move out of gold back into assets, but we're in no way, shape, or form anywhere near that.
Well, you're lucky. I don't have that luxury.
No, no,
People,
of course you know that. Yes, well, I mean, as an
people come
individual,
back, and yeah, as an individual, you can do that, but as a money manager, you can't say, I don't care about the price because you'll just lose capital and clients. Um, yeah, look, technical analysis is a subject for a separate podcast thing. It's just like for me, my views on this,
yes,
but I'll just say it out loud. For me, concepts of expensive versus cheap, they don't mean anything. I think I think these are just adjectives that have no real substance. They're just emotional assessments of price, you know. And in terms of technical analysis, when people say expensive, they refer to some metric, some calculation, and normally this calculation would be some sort of an average that they judge the relative cheapness or expensiveness of stuff. But like if you think about something like RSI, for instance, it's just an average. So when it's high, it just means that the price is at the top range of the average kind of range of the past period, whatever the period might be. But if you have a breakout and dramatic move, whether it's low or high, it doesn't matter. The RSI will just stay high or low for a long time as long as the trend is kind of ongoing. So they could be useful metrics if you believe that we're going to trade in a certain range and you want to know when we're at the top of the range. But then why do you need RSI for that, right? You can just look at the chart and there it is. You don't need a separate metric for that. So I don't like technical analysis from a philosophical standpoint. It basically says that the past tells you what the future will be. It's a bit like looking at the stars. I think we've touched on that before in our previous chats. It's a bit like looking at the stars, and they are not indicative of anything. And it's basically looking at the past because the speed of light takes whatever the whatever the speed is. It takes time for light to reach our eyes, basically. And it's the same concept, right? So I can't advise anyone to look at technical analysis and base their investment decisions on that. I think it's very naive and very kind of simplistic way of looking at things. So in terms of gold, I think it's also important to think about the relationship of gold versus oil, because they're clearly interrelated simply because the BRICS guys are both producers of gold and oil. Not all of them, but they are the bigger ones. So I would expect the historic correlation and like ratio of gold to oil to remain kind of constant as we go on. So effectively, I believe that if gold keeps going up, so will oil. And I think it's very important because oil is a critical commodity for the world and especially for the US. So I think there is a kind of a relationship there that people have to think about. And in terms of the hiking cycle, I think it did not, as you say, it did not achieve its primary objectives, but it did slow down the rally, right? So, despite all the printing and subsidies and fiscal spending, they did manage to keep a lid on gold price, kind of. Just because of these correlations, and everyone knows them, and everyone knows that, real rates are positive. Oh, it's a problem for gold. So people are reluctant to bet on it, basically, or to invest in it. Um, but I think it's important that we broke 2000. It's been a key level for a few decades, right? So we touched, I think it was less than 2000 in 2011. We came all the way back down to around 1000, 1200, I think it was, can't
Yes.
remember.
Yeah, something like that.
And then in COVID times, we hit a bit above 2000, then it was brought down again. But now that that these levels are cleared, I would expect them to form some sort of floor for the price. So yeah, and I think I don't really believe we'll go below 2000 in the near future. It doesn't seem that way, and I think it will be a nice floor to trade off. So if you want to know about my positioning, we are long gold. For disclaimer's sake, I have to say it. But it's a big question for us when to re-enter or when to add. You know, it's a difficult, like when the price is going up fast, it's very difficult to get into the position. And my idea is to trade off the 2000 level. So if we correct to say to 100 or something like that, I would try to add, I guess. So, not that it's an investment advice. You have to kind of make your own call on that, but that's what I'm going to do. And I think it's important that we broke through, like, and I don't consider that to be a technical analysis type of thing because it just means that the previous high has been broken, and there are plenty of reasons for that. Yeah, so it kind of worked, the hiking thing, the hiking cycle. It kind of helped them, but the primary objective was not achieved, of course. And I think they've stopped trying now. I think that I think it's pretty clear that the Fed will cut no matter what happens. We have an inflation reading today, which is probably going to be elevated given where commodities are and given where energy trades. But I don't think it will change anything in terms of what the Fed does. What do you think?
Yeah, a lot. Yes, I would tend to agree with it. Although the market tends to keep saying, well, the Fed must cut, the Fed must cut. And I would agree the Fed should have long since cut because of the damage this is doing to the broader economy, the damage it's doing to the financial system. In having elevated interest rates after a long spell of just zero interest rate policy, effectively. So, but yes, logically, where logic applies is debatable with the Fed. But yes, you would think they would have to start cutting interest rates. But one question I'd like to ask you, and because you and I off air, we talk about a lot of things, and is oil, because the US has made some horrendous policy decisions where they were trying to suppress the oil price to keep it around $70 a barrel. So they dumped the SPR.
Yeah.
And of course, it only bought some short term relief. And now they were kind of trying to start replenishing the SPR. And now they've given up going, price of oil is too expensive. So we're not doing it because they're effectively making a loss on that trade by trying to do this. But there was clear evidence, there was attempts to try and keep the price at around 70 or get it to 70, and it never really stuck there. And it seems they've given up trying to weaken the oil price in dollar terms. This is. Do you have any thoughts as to why they've given up, or and just seemingly just thrown the towel in and gone? We can't do this. Have you any thoughts on why they did? Why that's the case?
Yeah. Yeah, well, like I said, it's a critical resource. It's super important, and the structure of the American oil market is kind of specific. They have become a big producer, one of the larger producers in the world, I would say on par with Saudi Arabia, but the stuff they get from their production, from the local production, is very specific. It's of a very specific grade that you can't really use in all refineries all over the United States. And so I think they have to import um, other grades. And I think that's the reason why they've kind of stopped trying to enforce regime change in Venezuela,
Mm-hmm.
despite the obvious dislike of Maduro. Um, he's still there, and the sanctions have been lifted more or less. At least the paper is tradable now, the
Mm-hmm.
bonds, and there are some deliveries from Venezuela to US. So they need the stuff. basically. And in terms of trying to influence the price, well, the hiking cycle, the tightening cycle, is that was their best shot. You know, it always worked in the past. It always made oil more abundant because the emerging markets had to, compensate for the fall in price by supplying larger quantities of oil. But it's not like this anymore. So that doesn't work. But you still need this stuff, right? So you have to do something. In terms of repurchases of SPR, they have been very limited. It's true that they've started buying, but those are like millions of barrels, tens of millions of barrels, which is nothing. Daily turnover, daily demand for oil is 100 million barrels per day. So, if you add 10 million, that's like nothing. That's 10% of daily demand. And I think that's the point, it's the real world telling you what it's like. You can't really pretend that it's anything different. And if you remember Yellen, my favorite woman in finance, she was paddling this oil price cap thing for more than a year. And on my Twitter feed, I keep asking when will it happen? And it seems like it's not going to happen, right?
No,
Because
absolutely not. No.
yeah, because it's a scarce resource. It's very much in demand. It's critical. It's irreplaceable. It's the stuff that is not. You cannot do without it, basically. Yeah, so I think that's why the change. There's also a problem with the stuff that they have. It's really difficult to say how much of the stuff they have in terms of proved reserves in the ground. You have all these seeming problems with shale, depletion of reserves and stuff like this. So, it's also very much debatable whether they can keep up the current level of production in the future. I don't think they can. It will still be plenty, but it's probably not going to be at the 13, 14 million barrels per day kind of range. So I would say they're cornered in that sense. In terms of oil and its price and where it could go, well, that's a tough one. It's a notoriously difficult to predict market. We have been pretty bullish on drops to 70, as you know, we've discussed this
Yes.
privately.
Yeah, yeah.
And turns out it was the right call. At current levels, I'm not so sure anymore because 90 seems to satisfy Saudis, for instance. They're happy to trade at 90. And I mean, if 85 is the price for WTI for Aramco, it's probably 90 plus, right?
Hmm.
So there's a premium for their oil. So they could be more lenient in terms of the size of their production, right? But it's not going up. I think an important point will be in June or July, anyway, in the summer, because I think there was a decree by the Russian president that oil producing companies have to cut their production by 1 million barrels, and that's like a decree. So it's gonna happen. It's not what the companies want. It's just it has to be done. It will be done. And clearly, it's the geopolitical play, right? I mean,
Yeah,
it
for
can't
sure.
be anything. Okay, it's a profit maximization exercise, like companies do, but more than that, it's a geopolitical play. Um, can the US still release more of the Strategic Petroleum Reserve? Yes. They still have some gunpowder there, but it's not a lot. They can do it maybe for this year, and I don't think they will, to be honest. I think they'll keep it as it is, more or less. I don't know if I answered your question, man, but
No, you did. No, you did. And I think just a point to add, the trying to lower the SPR levels from where they are, I think is inherently risky. I think also in terms of the oil sector, OPEC Plus controls the oil price, and principally that's of course the Saudis and the Russians. And Saudi wants oil at $85 a barrel.
yeah.
They've made that position very clear. So clearly there is manipulation going on, going, well, if you're going to try and cut the price, we'll just cut production. But what I would say, and this is, you can throw it in the conspiracy angle of discussion, but I strongly suspect there is a lot more oil reaching certain destinations that isn't officially accounted for. And I'm not like Iran being a classic case of this, because Iran produces oil dirt cheap. And I
Mm,
think they've been supplying markets, and this is kind of off book stuff. People don't really know it's happening, but I think it is happening. Uh, and because obviously, if the market was aware of the fact that they were pumping another million barrels a day, then it would change the oil price. But because okay, there's the argument ultimately is the cut in supply Russia's doing, and we know it's of course it's political or geopolitical, but is it because the demand in the world is falling, and there's an argument for that. But what I would say is, given what's happening in the global south, and given what's happening in their economies and in terms of industrialization, etc., I can't believe that they're suddenly wanting to see a huge shrinkage in oil demand for them. And I have a feeling there is something going on, say, between the Iranians and the global south, and maybe Southeast Asia, where they're supplying a lot more oil than is conventional
mm,
wisdom perhaps would understand. But that's just a kind of theory I have. Not, I don't have, well, I have marginally some substance to it, but not the kind of smoking gun evidence that would definitively prove this to be the
mm,
case. But certainly the control of the oil markets is OPEC plus, and that's really, whenever
mm,
Saudi and Russia say something, all the other nations get into line and do it. They may be slightly disagreeing, although largely they don't. But when they do, in the end, they all just go, "Okay, that's what we're doing," and
mm,
therefore the US is, and that's a big shift in energy markets, and was a point for me I made going back quite a long time. At some point, Russia would stop. I think it's around 2016. I felt Russia would start to have a big say in energy markets, particularly like oil at that point in time. And now here we are 8 years later, where it's very self-evident that's the case.
mm. Yeah, I think global demand for oil is going up. The official numbers kind of point there. And I think it's driven by the emergence of the middle class in places like India and China and stuff like that. So I would expect oil demand to keep going despite all the attempts to move to green, whatever ideas. And so yeah, it kind of doesn't make sense, decreasing your production in a rising demand situation, but you have to realize that it's still a profit maximization exercise rather than satisfying the demand, right? You want to
Yes.
satisfy it at the price you want to satisfy it at, and it's inelastic, right? In fact, a lot of people don't know this, but the recent kind of GDP drop periods, right, like '08 and 2020, they did lead to a drop in demand for oil, but it wasn't as dramatic as you would think. It's and once it dropped, it clawed back up very fast. So it just it makes sense because again, it's very inelastic. We need the stuff. We need the stuff not just for energy. We need it for everything. So even if everything stops in like 2020, like for example, like in 2020, it just goes back so fast because it's irreplaceable basically. You cannot do anything about it. And if people want to wear clothes and there are more people, then that's what happens, right?
Yeah, absolutely.
It's funny. I had this interaction with somebody on Twitter once, and they were saying, "Oh, electric cars, EVs, all this. So demand for oil drops." But like, if you drove any of these EVs, just look at the amount of plastic in them. I mean, oil producers are salivating because like every car means more need for oil and the distillates. So it's I don't believe in this green energy replacement theory. I don't think we're anywhere close to that, and I'm pretty sure that demand for oil will go up. Now it's a problem. It's clearly a problem for US because one of the things that also a lot of people miss, it's right in their faces, but they still miss it, is how important the price of gasoline is for US domestically and politically. It affects so many things like consumer sentiment, spending, savings, literally everything. And since Americans are using so much more gasoline per capita than anyone else, it has a massive impact. I've heard that a $10 rise in the price of WTI relates to about 0.4% change in the CPI index, right? Whether it's up or down. And, it just makes things so complicated and difficult for the Fed and the Treasury that they will try to do everything to keep a lid on it. But whether they can or not, that's another question. I really don't know. I'm still long if you want to know what I think in real terms, in practical terms. We're still long, but maybe above 90, um, I'll start worrying a little bit if we get there, of course. But again, if gold keeps going up, then oil is likely to follow. Because for Briggs guys, they want to keep this ratio, stable because it makes transactions easier, more predictable, you know. So I think that will remain. So if I'm bullish on gold, I guess I'm bullish on oil as well.
Yeah, and there's a logical, as you say, logically that makes complete sense. And what you're saying. So, question: how are you for time? Because we've got quite a bit of other things to discuss, but we can always park it for another day. I don't want to impinge on your
Uh,
time too much.
well, I have maybe another 20 minutes, 20, 30 minutes, so we can cover some of it.
Okay, well, because you obviously,
Or we could do it another day, don't whatever you think is best.
well, I'm quite happy we can carry on as long as you're okay. So, yeah, because you obviously sent a bunch of bullet points just so everybody knows, and with discussion points, and you obviously talk about the issue of US fiscal policy. What's it going to be? Who's going to
Yeah,
effectively fund US deficits? And I think that's something we'll see how we go for time, but I think that's an extremely important discussion point. And it has, to be fair, garnered quite a lot of interest where people are starting to go, well, the US
yeah.
deficits are increasing $1 trillion every 90 days, and there's no end to this. And I've discussed it on my own podcast about where this is likely to end up. And I think it's good to share your thoughts on this.
Yeah, I think it's 1 trillion in debt, not in deficits.
Oh, sorry,
But
and yeah, every 90 days or so, 100 days.
yeah,
Yeah,
it's still humongous. I mean,
yeah.
it's still bad. But if it was deficits, gold would be 10K or something. But yeah, so I think it's important to ask yourself a couple of questions. If you're managing money or if you invest it or something like this. And I think key questions are what will happen to US fiscal spending in, say, a year's time or 2 years' time, or over that period? Who will fund it? Because even now, the projection for 24 is that the deficits will be around 1.5 trillion. I think um, that's the projected number, official, and that assumes no recession, nothing goes wrong, oil doesn't spike, all that stuff. So it could be bigger. And I think we're running out of pockets to fund it, basically. Um, um, and so that's who will fund it is the second question. And the third one is what effect on liquidity this will have. And this one is the trickiest one because we don't know in what form this liquidity will arrive, right?
Uh-huh.
I think it's fairly clear that fiscal spending will continue in US. And I think if Trump wins, he's actually more of a fiscal hawk than Biden, amazingly, because Biden is all in on fiscal. But I think Trump is going to be even worse in that sense because he's Mr. Debt, right? His whole empire is built on debt. That's the only thing he kind of knows how to manage well. He understands that though, which is a positive. But I'm sure that if he wins, he'll try to push as much fiscal as he possibly can, because on the monetary side they can't do anything really. So I would assume that more fiscal programs will be out, more subsidies, more central planning, you know. So it just means that the deficits will continue to rise, and the need for financing will rise too. In terms of who will fund the US deficits, well, it's pretty clear that it's going to be either the commercial banks or the Fed itself. There are just no balances in the world that allow for this kind of money to appear out of nowhere, right? The foreigners are not buying, at least the ones you want to buy, they're not buying. Some offshore zones like Caymans and Ireland and stuff like that. You see some demand from there, but these are not foreigners really. These are your hedge funds or US corporates buying the stuff. So no extra demand from the world. So I think they will basically monetize. We can talk about how they will do it, because there are different ways they can go about it. I mean, there's been a lot of talk about the supplementary ratio being changed again. I think there was a letter from ISDA to the Fed saying that they have to reintroduce it. So theoretically, it could be the balance sheets of commercial banks, big US commercial banks, but in reality, it doesn't matter. It's so transparent, so obvious. It really doesn't matter if the monetization is done on the Fed's balance sheet or the banks making up the Fed's balance sheet. It doesn't really matter. But what will happen to liquidity is another story, because it really depends on how they're gonna put that money into practice, basically. So, if they just do the QE thing in whatever form, then it's likely to just influence financial inflation. So, financial assets are likely to go up. If they do 2020 style, whatever you want, here's the money, spend it with um, no need to kind of report it or anything like that. So basically, helicopter money, then we'll get another inflationary spike on top of the energy spike. So that's that's like the worst thing that can happen, I guess, for economics and all these numbers. I actually don't think they'll do it because the this ghost of inflation is still kind of scaring them. They clearly didn't expect inflation to be as bad as it got in 2021. So I think they'll be very careful with helicopter money, but they'll have to stimulate. And I'm guessing it will be a repeat of QE of some form. Um, and yeah, so and um, typically these liquidity injections are positive for all markets, more or less. But I think this time could be different because we have this gold breakout, we have these questions about the dollar and US Treasuries, more importantly, as I've mentioned. So if the demand for US Treasuries keeps dropping, it could lead to depreciation of the dollar, a significant one, and that in turn could scare the foreign investors in US assets. I mean, I have no idea what kind of repricing has to happen for these things to evolve in this way, but it's clearly a risk, and it's clearly a risk that people forget exists. I started off in finance as an FX trader. I traded interbank for a couple of years, and it was actually a great experience because not in terms of pay, but in terms of experience, it was very good. And it basically showed me what the fixed world is, and it's still the biggest market out there. And back in those days, that's like 2000, 2001 kind of period. Uh, we had a lot of volatility, in FX. We had moves of, I don't know, 300 basis per day, sometimes more. So much more volatile than the cross rates are today. And I think there's this expectation from the market participants for volatility to stay low in FX because it's been so low for so long that they stop managing that risk, and or they kind of lenient with it or something like this. But if it comes back, if vol comes back, it could lead to a kind of a shock, if you want, and a rush for the hedges, or just get out of the assets and forget about it kind of story. So I'm very wary of that, and I think everyone should be. So, and from my experience, people don't get a fix. I think I've said this before on your podcast.
Yeah, for
It's
sure.
just it's just unnatural for humans to think that way, and they don't. And it's but and I see this every other day with my clients. When you start talking about currency base, you lose them. They don't understand it. They don't think that way. But you should always think through the prism of your base currency, and base currency is basically what you spend in. It's that easy. So you have to bring your capital to that currency, not some abstract thing. I guess you could count your capital in gold, but nobody does it. So probably they should, but they don't. Yeah, and I think there is a very good chance that we'll see another spike in inflation just because you know all the stuff that we talked about, like oil prices and just general fiscal spending, I guess, because it is inflationary. If you print money and put it in the economy, it will inflate certain price levels for sure. So it could happen, but I think it will still be not enough for the Fed to change its course just because the maturity wall is hitting us in 24 and 25, right? And by maturity wall, I mean just bonds, credit being run off, right? Ending its life, maturing, and you have to kind of roll it over. And given the prevailing interest rates, it just means that the interest rate expense is going up massively. So they have to bring it down. And I mean, when I mean maturity wall, I mean pretty much all debt. So, treasury, high yield, commercial real estate, all types of things are coming in 24 and 25. And I think that's the main reason why the Fed is so intent on cutting rates. And I do think they'll cut first time in the summer sometime. So, and it's tricky. It's very tricky because you would assume that like an easing cycle would lead to stock prices going down, but going up. But then you have the question of the dollar versus other currencies and what the foreigners will do. And foreigners own a lot of American assets. I mean, more than Americans own overseas assets. And the liquidity side of it as well, if we still have the reverse repo thing influencing the markets, we still have the treasury account sitting there with a bunch of money doing nothing. We still have the QT going on, despite which is super stupid in my eyes. I mean, I don't know why they're doing it still. It clearly failed. They clearly have to stop it. So and right now you have some parts of this puzzle influencing liquidity negatively, and others positively. So it's super difficult to judge what it all means for stocks because they're clearly related to interest rates, but also they are very influenced by liquidity flows. So it's up for grabs, basically. We normally don't trade indices, right? We stock pick. We still do hold some US stocks, um, but very selective in what we hold, basically. And the stuff we hold is in the commodity space. So, gold miners, oil, oil developers, uh, metal miners, stuff like that. Uranium stocks we also like. So my point is you can still be invested in certain stocks, but you have to realize what they are. And I would advise against trading indices these days. It's just too foggy, it's too difficult to kind of predict anything, to be honest. I am looking at bank reserves. I think they're critical in terms of where the stock market might go. And they seem to be rolling over for whatever reason. I don't know what the reason is. I was trying to figure it out, but I couldn't. Maybe the fact that reverse repo is not changing much these days. I think a lot in the picture of what will happen to liquidity and what will happen to U.S. Deficits is the taxation side of things. We're in April, so we'll know what kind of tax income the U.S. government is going to receive pretty soon, by the end of the month for sure. And I think that will influence the issuance and what they will do. If tax revenue comes in okay or better than expected, then I think they have enough money printed, so to say, until the end of the year. But that's it, and again, that's assuming that no recession is happening and assuming everything is kind of, you know, as it is right now, which is probably wrong to assume, right?
Yeah, I mean,
So yeah.
Yes, probably, yes.
Yeah, so you know, it's a lot of things are moving at the same time. Um, yeah, um, I think by the end of the year we'll run out of all these liquidity pockets like reverse repo, and we'll know how much how much indexation the economy is generating, and I think it will be much clearer to towards the end of the year. That's my take, at least.
Yeah, I mean, all I can add to that, I totally agree with you. I think fiscal deficits and will be they come out with figures. The Congressional Budget Office, and they're always way underestimating. It'd be way higher than
Yeah,
the
always.
rest
Yeah.
always is. So they're only going to rise. And you're right, if Trump gets elected, he'll just spend like there's no tomorrow. Uh, and therefore, it does come to the point: who's going to finance this? And with regards to buying treasuries, it's clear foreigners haven't been buying treasuries largely for a decade. There's a lot of these accounts all over the world that they're not foreigners buying. There's all sorts of chicanery going on and treasuries being squirreled here, there, and everywhere. But the bottom line is a lot of the US banks didn't want to touch them. And then the treasury buying was in money market funds and shadow banking and hedge funds. And they're basically getting to the point for me where they're almost going to be maxed out. Hence, change the SLR rate to force banks to buy treasuries. But in the end, there comes a point where they're totally maxed out as well. And then there could be liquidity issues. We may, for argument's sake, have another repo crisis, which is quite well, not likely, but there's a potential for it, depending on, as you say, what happens with tax receipts and do they drain the TGA and the reverse repo quicker than we anticipate. But at some point, the whole thing's going to be drained. It's rather like saturating the market with debt. In the end, just to use an analogy, the consumer debt market just becomes totally saturated. No one can take any more debt on board. And in the end, no one can take any more treasuries on board. And then it's left then eventually to the Fed to monetize everything. Now, for me, setting aside what it does to the gold price, etc., I think that's the moment where, and I think a large part of the so-called global south, and I include the West Asian nations in this, the Chinese are looking, the US going, you're just, this is banana republic territory. You're just going to print this, and then I think you might start to see enormous amounts of dollar assets being dumped, and there is evidence of money and capital outflows out the US, back
Yeah,
to China
you
and
know,
to West Asia. So I think it's a snowballing effect where that then may have massive repercussions for those institutions like banks who are going, well, we're absolutely maxed out. Our capital buffers aren't worth the paper they're written on. We get massive capital outflows, etc. We're going to be in serious trouble. Never mind what's happening in the broader sense to bond markets, because okay, they can cut interest rates. I mean, what's going to happen in terms of the bond markets themselves? And I mean, it's this for me is another point, and it's a huge talking point. But I think that's very difficult to predict in terms of so there's all these things happening and conflating all at the same time. And then there's all the risk of commercial real estate defaults, there's real estate defaults, there's corporations bankruptcies arising, and because the real economy is cratering. And the clearest example of that is the US is replacing what you might term full-time quality jobs that are well paid with very poor quality jobs, very low paid. The waiter and waitresses kind of mentality or belief, and because the US economy is falling apart. So, and to use a very crude analogy, if it gets to the point, and which is why they printed trillions in 2020, because they were fearful, well, if the entire population ends up being screwed because of what happened in the pandemic, we have to bail everyone out. Then there may come a situation where they go, well, we might have to do that again because the real economy is going to eventually shatter the illusion of the financialization of economies for the last 40 years. So there's all these things playing out at the same time, and at some point the dam will break. I mean, it's absolutely irrefutable, and it's just the cascading effect and the systemic problem that will create in the process. And okay, it's very difficult to quantify it precisely, but we're heading in that direction. In the end, there'll be nobody except the Fed will have to monetize everything. And if deficits are spiking, and then there's all these other problems in the economy, and then we may end up with 2020 on steroids. I'm not saying we will, but if things don't pan out, it's that, or do we risk massive civil unrest in the United States? They can't risk that, rightly so. And then the rest of the world's going to look at this and go, I don't want to hold dollars anymore. I'm never going to buy US treasuries. And I'm going to, and also, the weaponization of the dollar, etc. And they're all going to start en masse pulling money, or trying to pull the money out of US banks, and the massive capital outflows. And these banks are just going to be incapable. It doesn't matter whether they're too big to fail or more regional banks, they're not going to be in a position to cope with this. And then the whole thing just is this complete, well, dare I say it, meltdown scenario. But that's potentially where we're going, and it could happen far sooner, I think, than people anticipate.
Yeah, it looks like the beginning of the end of the system, I would say. If you think about the Saudis, or, the Arab world producing oil, those countries for whom the like sales of oil are the biggest, revenue uh, uh, part part of their trade balance. The oil price has not kept up with the official inflation, even, let alone real inflation numbers. So by now it's pretty clear for the Arab world to see that, the system, the previous system is not really working out for them, because despite all the printing, despite all the increases in the monetary base, their product has not inflated alongside with the with the increase in the amount of paper money. So something is clearly off, right, from their perspective. And that comes on top of, the Russian central bank freeze and all these wars and, all this stuff, all the questions to do with security, who guarantees it? Is there anyone who guarantees it? All these things. But even in kind of basic economic terms, it's really a bad deal for them, over the long period, like from the 70s. So, I think that influences people as well in terms of whether they buy US treasuries or not. And again, I want to stress once again that it's not the dollar, it's the US treasuries that are super important, because they are the collateral. They are the ways of financing the deficits, right? Because without them, you don't get the money from the world, right? That you need. Yeah, and I think another point that is worth discussing is that the U.S. Treasury is actually being forced to finance everything on the short end, right? They tried to issue more debt, 10 years plus, and it failed. It basically led to USD sales, um, very linearly, and it led to a banking crisis in 23, in March of 23. So they can't really issue long-term debt, so they're doomed to issue short-term debt, which is exactly what they're doing. And right now they're trying to do all these weird things like treasury buybacks, which is the dumbest idea ever. Because essentially what you're saying is, I'm going to issue debt to buy back the debt that I've issued, with a different duration, but you're still issuing more debt. It's not your job to manage the curve. Why are you even trying? But they keep trying, I think they actually bought something, some, not a lot, but they're trying to kind of manage the curve somewhat. But the idea itself that you have to finance all of these trillions on the short end mean that the short term interest rate has to fall for it to make any sort of sense. To what level, I don't know. I think they'll be trying to kind of micromanage it and see what happens, but it has to be lower than it is now, at least for 24, 25, when all the refinancing, until all the refinancing is done. And then maybe if things are okay and the fiscal spending is actually productive, then it could be a different story. And that's the issue, right? It's uh, it's uh, it's important how you allocate the money. Like, say you decide, okay, I'm gonna print some money and give it to some companies, say, to develop some products or to get an advantage in a certain industry, something like that. You have to do it right. You can't make a mistake, because if you make critical mistakes, it just means that all these money issuance is unproductive, and it just leads to more debt. You have to come up with something that is valuable and makes sense. Whether the US can do it or not is up for debate. They did push for the chip making factories, right? There are a lot of subsidies going that way, and I guess it's a good thing, because you can't build a non-reserve country without local manufacturing of critical stuff, right?
Mhm.
So it's the right push, but it's not as easy as they would like it to be, right? Because these are very complex factories. The kind of stuff you need, the kind of workforce you need is very scarce. Um, the prices are going up. The unions are against you. The taxes are against you. But the push is there, but it has to be productive. I'm not sure if they will succeed in a short period of space. It doesn't look that way, at least. Um, so so yeah, and I think it clearly shows all this stuff with the short end and long end, how cornered the Fed and the Treasury really are. Um, and I mean, this idea of Yellen traveling to China, why is she going there as if it's her, holiday house or something? She's been there for like 10 times in the past couple of years. Well, I never counted, but it's more than two for sure.
Yeah, it's
Um,
been pretty regular in the last 12 months.
yeah, it's like she has a second family there or something. Doesn't make sense. And it just shows that they're looking for these solutions. Another thing is they tried to pitch this idea of a reverse twist thing. Did you hear about this? Have you heard this?
Yes, yeah, yeah, yeah.
So basically, monetizing the short end U.S. Treasuries and selling long dated MBS, mortgage-backed stuff. But with commercial real estate being a clear problem, I mean, it's obviously a problem. If you sell these MBS, wouldn't this affect the housing market and the real estate market even more? Of course it will,
Yes.
right? So can they even do it technically? I'm not sure.
But the question
So
is, who's going to buy them anyway?
yeah, exactly. Who's gonna buy them? I've heard a theory that they're gonna guarantee them, kind of thing. But then why do you sell them at all if you are holding all the risks, right? I mean, you might as well keep them if you want. So, it's a lot of problems and no clear way to solve them, I would say. Um, And I think, but I think this year is critical. And I think all these breakouts and all these breakdowns of correlations are just symptoms of these changes. And you have to, and I mean, you have to be vigilant and you have to keep track of these things, um, and don't use technical analysis. I mean, is that in
No,
this kind of
absolutely.
scenario, it's just not going to help you. It's going to make things worse for sure. So you have to stay objective and true to your beliefs, I would say.
Yeah, I mean, what all I would add to that is, I think for another time, not today, we is to have a broader discussion about where the US goes in the future and where it is now, where the broad problems are. How does it attempt to resolve? That's for me a very interesting subject, and that's probably something that will take a long time, but certainly not today. And the only other point I would add to what you've said is, for me, for if the Fed basically throws in the towel and slashes interest rates, which I think it will have no choice for the reasons we've said, whether it happens in June or they start the process or whenever, ultimately they'll have to do it. But I think once they slash interest rates, then really for me, that's them holding up the white flag, going, we can't defend the dollar anymore. We're not even going to try to. It's over, as the dollar is now. I have to be very careful what I mean by that. I think it's them throwing in the towel, saying it's over. There's no way around this, because and logically they have to. So what that means.
It's actually beneficial for the US, I would say, over the medium term.
Well, ultimately,
To
yes, to stop being the world reserve currency and being able to, as it
Yeah.
has been, and to be able to adjust its economy and oh yes, I mean, and change its whole fiscal monetary policy, and actually find ways. And that's part of the discussion in the future about what does the US do. Then I'm with you. Ultimately, it will have to make massive changes, and for a lot of the US, that's unpalatable at the moment, but the realization will come there's no other choice. And in the
Yeah.
medium term, the long term, whatever that might mean, and that depends on how quickly people recognize it and how quickly there's someone who has the capability to know what to do. And that's very difficult in Western countries. But if they do, then the US can have a far brighter future. But it's going to have to change. I mean, it'll have to not have 800 sorry, military bases all around the world. It'll have to stop being an hegemonic power and weaponizing the dollar, etc. But the US can have a far better future and become what I've termed a great nation amongst equals, and to at
Mhm.
some point regain the trust. I mean, that's a huge problem, but that's what it will have to do. And for me, I think there's an interesting discussion about in the future as to how do they do that. And but for
Well,
sure,
that's the yeah,
ultimately it
that's
will be beneficial to them.
yeah, that's the thing, if you the number of military bases makes sense if you are the sole reserve asset current/currency guy, right? You have to protect your hegemony. But if you're not, for whatever reason, naturally or by a decision, then it doesn't make sense to spend all this money on these bases, right? You might as well spend it on, border guards or a chip factory or whatever, something that is, because these things are super unproductive, well, especially when the usage of the dollar is in decline. You still spend the same amount of money, probably more with inflation and everything going up in prices, right? So it becomes very unproductive, much like the extra debt that you issue that generates, like, I don't know, $1 of GDP for $2 of debt. If you keep doing this forever, well, guess what's going to happen? It's going to be less and less productive as you go on. And the same goes for, the military and all these projections. I mean, this stuff is pricey. And it's not like people think that, you have to compare military budgets. But you can't really compare Chinese budget to the American budget because the Chinese are not spending on military bases, not as much, you know, they don't have as many. So it's cheaper. And their budget goes to, you know, R&D rather than paying for gasoline of the cars driving around bases, you know? So it has a lot of implications in terms of how the world works, and I would say for politics as well, who is, you know, being elected, who is given the financial support and all that stuff. So I'm pretty sure 24 will be one for history books. That's my kind of expectation. And market moves are kind of pointing into that direction too.
Yeah, I agree. I mean, I'm not one for getting drawn on dates because I always say, which infuriates people, but it's we're in an event-driven scenario, and things will happen in a sequential order. I mean, but logically, we're in that kind of window of 24 and maybe into 25. I mean, okay, they'll do everything to try and prevent the date with destiny, so to speak. Okay, it doesn't ultimately change anything. It doesn't even stall anything. In some ways, what they do now is likely only to accelerate the problems. But yeah, I would agree with you on that. So, well, probably that's a good point to stop from your perspective, and I'd happily chat for hours, but you've got more important things to be getting on with. So, obviously, Paul,
Yeah,
thank
my
you very
wife.
much.
I'm sorry. My just a little anecdote. I have
Uh-huh.
to run because my wife just messaged me and she said my kid was bitten in high school.
Oh.
So nothing happened, but I have to go and check him out now
No,
by
well,
some
absolutely.
hygiene.
Well, just quickly, Paul, thank you very much for coming on today. We'll really appreciate having a chat with
Yeah,
you, and I hope everyone who listens will appreciate the discussion. And just one final point to emphasize your point: everything we've discussed is not investment advice; it's just informational purposes. But you have to go and consult with whoever your financial advisor is to make the appropriate financial decisions. It's not what we've discussed isn't trying to influence or make people invest in anything in particular. Just to emphasize that point. Okay,
yep,
I'll let you
for
go
sure.
then, Paul. Okay, all the best. Take care.
Thanks a lot. Thanks a lot, Paul, and it's always a pleasure. So
Yes,
anytime,
yeah,
I'm happy to do this again, and maybe we focus on the US next time.
yeah. Thank you very much and take care. All
Thank
the
you.
best.
Bye bye.
Bye.